You wake up early, you go to work, you trade your time, you collect a paycheck. And before that paycheck even reaches your account, a portion of it is gone. Federal tax, state tax, payroll tax, you never even see the full amount. Now zoom out. Somewhere else, someone's net worth increases by $500 million this year, and they may report little or no taxable income. Not because they cheated, not because they hid money offshore, not because they broke the law, but because they are operating under a different financial logic. And if you don't understand that logic, you will spend your life running uphill while others are carried forward by structure. This is not about anger, it's about architecture. The tax system is not random. It is built around incentives, and those incentives favor capital over labor. Let's slow this down and rebuild your mental model from the ground up. When you earn income from a job, that income is classified as earned income. Earned income is taxed at ordinary income rates. It is immediate. It is unavoidable. It is predictable. Now compare that to what happens when you own an asset. You buy a share of a company. You buy a rental property. You invest in a private business. If that asset increases in value, you do not owe tax on the increase unless you sell. That increase is called an unrealized gain. Unrealized gains are invisible to the tax system until realized. That is the first critical structural difference. Labor is taxed as it flows in. Capital is taxed only when it exits. Now imagine what that means over 30 years. If you earn $200,000 per year in salary, taxes reduce your ability to compound before compounding begins. If you own an asset that grows 8% annually for 30 years without interruption from taxation, the growth compounds on the full amount. Tax drag is one of the most powerful invisible forces in wealth building. Every time you pay tax, you remove fuel from your compounding engine. The wealthy design their financial lives to reduce tax drag as much as legally possible. They do this through structure, not shortcuts. Now let's introduce the second layer. If wealth is stored in assets and assets are not sold, then how does someone live? This is where most people misunderstand what leverage actually is. Debt is not inherently destructive. Unstructured consumer debt is destructive. Strategic asset-backed debt is a tool. Let's imagine someone owns $20 million in publicly traded equities. Instead of selling those equities, which would trigger capital gains taxes, they pledge them as collateral for a line of credit. A bank evaluates the risk. The assets are diversified, liquid, stable. The bank extends a loan. That loan provides cash. Loans are not income. They are liabilities. The tax system does not treat borrowed money as taxable, so liquidity is created without realization of gains. Meanwhile, the underlying assets remain invested. If those assets grow faster than the interest rate on the loan, net worth continues expanding. This dynamic creates a powerful feedback loop. Assets grow. Borrowing provides liquidity. Taxes are deferred, but there is risk here. If markets decline significantly, leverage amplifies losses. If the asset value drops too far, lenders can demand repayment or liquidation. This is why disciplined risk management matters. The wealthy who use this system successfully do not operate recklessly. They diversify across sectors and asset classes. They monitor leverage ratios carefully. They maintain liquidity buffers. They treat debt as a scalpel, not a hammer. Now we reach the third structural pillar, intergenerational transfer. Under current U.S. law, when assets pass to heirs, the cost basis resets to the fair market value at time of death. This means unrealized gains accumulated over decades can effectively disappear for tax calculation. Let's examine the economic implication. If an investor purchased real estate for $500,000 and it appreciates to $5 million over a lifetime, selling would create a large taxable gain. But if the property is held until death and passed to heirs, the basis adjusts. Heirs inherit at $5 million valuation. The prior gain is not taxed as capital gains. The wealth moves forward without the historical tax drag. This is not an accidental glitch. It is embedded in the estate and capital gains framework. And this is where generational wealth begins to behave differently than earned income. Wage earners restart every generation. Capital can move forward with minimal reset. Now step back from the mechanics. The larger theme is incentive design. Governments want capital formation. They want companies built. They want infrastructure developed. They want markets functioning. So the tax code incentivizes ownership. It rewards long-term capital deployment. It penalizes short-term extraction. Wage labor is essential, but it is not privileged in the tax structure. Capital allocation is. This is not a moral statement. It is structural reality. And once you see structure, your strategy changes. Now let's address inflation, because inflation is often misunderstood in this framework. Inflation erodes the purchasing power of currency. Debt is denominated in currency. If you borrow at a fixed rate and inflation runs at similar or higher levels, the real burden of the debt declines over time. Meanwhile, real assets, equities, real estate, businesses tend to rise with inflation over long periods. This creates asymmetry. Asset holders benefit from inflation if leveraged responsibly. Cash holders lose purchasing power. This is why long-term wealth builders rarely sit heavily in cash beyond operational liquidity. Cash is a tool, assets are engines, but let's be clear, this framework does not mean everyone should immediately begin borrowing aggressively. It means you must build an asset base first. It means you must understand risk. It means you must differentiate between productive debt and consumptive debt. Borrowing to fund lifestyle inflation is destructive. Borrowing to acquire appreciating assets, carefully, can be strategic. And that requires education, discipline, and patience. Now let's talk about mindset. Most people are conditioned to optimize for income, raise salary, work harder, climb corporate ladders. There is nothing wrong with income growth, but income is linear. Assets are exponential. Income stops when you stop working. Assets continue working even when you sleep. The shift from worker to capital allocator is psychological before it is financial. You begin asking different questions. Instead of how can I earn more, you ask, how can I own more? Instead of how do I eliminate all debt, you ask, how do I manage strategic leverage responsibly? Instead of fearing taxes emotionally, you study the tax code analytically. You align your behavior with incentives embedded in the system. Now here is where most viewers will misinterpret this message. They will think this is only relevant to billionaires. It is not. The scale differs, the principles do not. You may not have 20 million in equities, but you can build diversified index exposure over time. You may not access securities-backed lending tomorrow, but you can prioritize asset accumulation over lifestyle inflation. You can understand opportunity cost. You can understand tax drag. You can begin thinking in decades instead of months. This is where wealth divergence begins, not with a secret offshore account, but with a different mental model. The message is, build assets, understand leverage, respect risk, play long-term, reduce tax drag, no shortcuts, just structure. The system will not change overnight, but your understanding can change today, and once your understanding changes, your behavior changes. And once behavior changes, compounding begins working in your favor instead of against you. This is not about resentment. It is about literacy. Financial literacy at the structural level. And once you see the architecture, you stop feeling like the game is unfair. You realize you were just playing the wrong level. That is Money Science AR, and now you are thinking like a capital allocator.